This is a download from BFM 89.9, the business station.
Good morning, Dodge. Let's focus on the Apple earnings. What are the kind of expectations that we can come from this earnings report?
Well, it's going to be the consensus earnings estimate is $1.97 per share. The revenues, which is more important at this point, is around $52 billion. And the whisper number that we're hearing now is $2.04 per share, so it's positive. Investor sentiment going into the earnings, over 50% expect an earnings beat. The company's guidance for the earnings of $1.83 to $2.03 probably is going to be the range, and anything above that will be viewed positively. Consensus estimates for the earnings are to decline by over 15%, with revenue decreasing by 10%. And there are some points that we're going to be watching. Obviously, the hardware-centric business model that's their biggest growth risk. Their margins will rise, which is positive, with the product mix and manufacturing efficiencies, which we think they can handle. The iPhone dominates its sales, and that poses a product transition risk. And the expectation is that Apple will be able to adjust and transition, but that's going to be the challenge, and the investors' expectation of its ability will drive the reaction, the short-term reaction in the market. Right now, we suspect it's trading around 105.5. There should be some support, some real support, the short-term at 104, but it's going to have to prove that it can meet the future challenge of transitioning away from hardware for it to get above 110.
With the fact that they are moving away from hardware, do you think they are more than ready to capitalize on the software aspect, particularly when their international contributions in the software aspect is still struggling?
Yes, that's the question, and we suspect it will. But it's going to this time around, Abraham. It's going to have to prove itself. In other words, the market is going to look for more proof and validity that Apple can make the transition. It's not going to be in a short process, and that's really we're going to see what the reaction is, and we're not as reliant upon the earnings outlook as more than we're really looking at what they're talking about in terms of revenues and the makeup of the revenues and the margins that's going to result from the transition of the revenue stream.
We saw that the US dollar strengthening has affected their revenue because it's going to get more expensive for overseas customers to buy Apple products. Do you think that the market will try to adjust this to meet the demand?
Yes, I do. And it's going to be it's going to be the relationship as to how much of the growth is going to come abroad, particularly China, for example, and how much of a stalling will there be here in the United States, which is a rather well-developed market. And yes, the U.S. dollar is strengthening. It is hurting. We're watching it very closely right now. There's the real strength is between the U.S. dollar and the U.K., and that's because of the Brexit fears, although they seem to be waning a little bit right now. So, yes, the U.S. dollar is going to have an impact, but more important for Apple longer term, that will be a short-term consideration. More important is will they be able to transition away from the hardware and continue to have improving margin requirements.
Let's focus still on earnings, but this time on Exxon. Do you think they are a conduit to the energy sector on how they earned for last year?
Well, Exxon is definitely a different story. It's more positive and it's more commodity-based. Yes, Exxon is going to report first quarter net income of about $1.29 billion, and they haven't logged a sub-$2 billion profit since way back in 1999 when it merged with Mobil. So the first quarter should be Exxon's earnings trough, and we expect that it's going to be affected positively by oil prices. Oil prices have been rebounding sharply from this winter's 13-year low. Of course, there was a prediction that the first half of 2015 would be the earnings trough, and it hasn't happened yet. But now we're beginning to see more of an upward bias in the price of oil. Exxon is very well managed. It has superior management, long-term staying power. It has already slowed its share buyback program. Its dividend growth likely will be curtailed, and so that is due to not only to commodity price weakness, but also they're looking at potential inorganic growth opportunities for its upstream business. So with its management and its ability to acquire other companies, we're more positive with Exxon. It looks quite favorable. It's about to, at 87.5, it's really testing the high that we saw back in October. We expect to have a positive reaction to their earnings on Friday.
You spoke of oil. In fact, the Brent touched briefly $45 per barrel before we head into the weekend. The gold right now is over 1,230. In fact, commodities in general is going quite strong. What do you think is driving this rally?
Well, the oil is driven by the lack. Well, there's a lot of what's happening now is being prompted by short-term factors such as supply disruptions, while the longer-term supply problems such as oil of excess capacity will persist. We see this both in oil and steel. Now, steel, a jump in Chinese steel prices is driving a broad-based rally that has sent iron ore, which is the key steel-making ingredient, up over 15% last week. Oil also had its third week of gains last week. Restocking of Chinese steel mills and improved hopes for infrastructure demand sent iron ore up on Thursday. Steel prices have jumped 60% in China, despite a worldwide glut. Much of this price action is really being driven by Chinese investors on the Shanghai and Dalian futures exchanges. So what we're seeing is really these are short-term volatile transactions that are occurring that are not really related to the fundamentals behind the commodities. So we do expect from the short term that other than oil and gold, that we will see continued strength, but it's going to have to prove itself longer term, and we suspect that there will be a move back in the other commodities. But with oil and gold, we do expect oil to have a much more positive-looking forward future. And with gold, we are seeing continued strength, and we suspect both will continue to be the favored commodities.
Gold is sometimes considered as a haven commodity. Do you think gold will continue to have that attraction towards investors who want to arbitrage their position?
Yes, I do. I think it's a safe commodity. They're not looking for yield on it. We're seeing some weakness in the high yield and the real estate investment trust sectors, but gold's not going to be affected by that because there is no yield. It is a commodity that has a long-term value. It's been over the years, the last trend was we're really reacting to a lower low in gold, and now we're seeing a much more positive reaction. So we suspect that there will be a continued momentum to the upside in gold. Oil, we suspect that short term it will continue to look to the upside, but at some point there will be a balance between short term variations as a commodity being traded and the long term supply issues.
Finally, do you think there is a great divide between what the market is doing visually and what is happening internally?
Well, yes. I mean, if you take a look at our markets, for example, longer term, it's beginning to improve. The intermediate term is very positive, and we have to give the intermediate term the benefit of doubt. Yes, the short-term outlook is looking a little bit more of a pullback, but we suspect there's going to be support. But that is really looking at the market as a whole. If you look under the lid, you're going to see that the buying power is typically measured as the volume that's associated with stocks that go up versus the volume associated with stocks that are going down. Buying power has actually dropped, showing that investor demand has been weakening during the recent rally. Now, that's not healthy longer term. Also, during healthy bull market rallies, the number of stocks rising to 52-week highs typically climbs quite sharply, often exceeding 20% or more in a single day of trading. But during the current rally, new highs peaked at just 10.1%. So there's really not that much strength in it. Also, new bull markets are generally led by small cap stocks. However, when you look at the S&P 500, it's been the large caps that have really pushed the S&P up, and also the Dow. The strength of the rally, because it's being focused on large cap stocks, is typical of an early phase of a bear market move. No, we're not calling for a bear market. We're just concerned we would rather see the market, which visually looks quite strong based on some of the major indices and averages, develop a little bit greater breadth in order to avoid the potential for a further pullback.
That was Dorland, Chief Investment Officer at Landor Fuest Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.